Hello, and welcome to Sarah's Opening Bell. As a stock market game investor, you have the option to invest in stocks, bonds, and mutual funds found on the New York Stock Exchange and NASDAQ. Now, although most stock market game investors follow and understand the process of buying and selling securities, I'm sure you've noticed the additional option to short sell or short cover. So to help you make the most of your investment decisions, I'll help explain what it means to short sell. Now, typically, an investor buys a stock in the hopes that it will rise in price. Now, short selling or just shorting lets investors make a bet in the opposite direction. Instead of buying a stock for a lower price and hoping to sell it later for a higher price, with short selling, investors sell a stock today at a higher price in the hopes of buying it later at a lower price. And you may be wondering, how can you sell a stock you don't even own? Well, to short sell a stock, an investor must first borrow the stock from someone else. And the entire process typically works this way. You identify the stock you want to short. You then borrow the shares from a broker or another lender. You then sell those shares at the current price, and the hope is that the stock will fall in value. Once it does, you buy back the shares at a price that's lower than what you sold them for, and then return the borrowed shares back to the lender. Let me make this even easier to understand. Imagine you have a friend who owns a rare baseball card that everyone thinks will lose its value soon. You think it's going to drop from $100 to $50. So you borrow that baseball card from your friend and you sell it right away for $100. Now you wait for the price to drop. If it falls to $50, you go and you buy the same card back and you return it to your friend, and you've just made a profit of $50. Now, short selling can be attractive for some investors because simply buying stocks only allow you to invest in companies going in one direction. However, with shorting, if you're right and the stock price goes down, you can make a lot of money. Now, when determining whether to engage in short selling, investors may look for things such as overly high stock prices, lower than expected profits, big customers leaving a company, or even something as simple as negative press. Now, although short selling can be a useful tool for some investors, it is not without its share of considerable risk. Typically, when you buy stocks, you cannot lose more money than the amount you've invested. But with short selling, there are no limits to the amount of money that you can lose. If the stock price goes up instead of down, you can lose a lot of money. For example, if that baseball card suddenly became super rare and shot up to $500, you'd have to pay a lot more to buy it back. So why does short selling even exist? Well, it provides a way for investors to make money in a declining market, and it helps keep stock prices in check by revealing when companies may not be doing well. And even among experienced investors, shorting is still considered a very risky approach. So if you decide to place a short sale order in your stock market game portfolio, make sure that you understand that it comes with significant risks. And if the risk ever seems just a bit too great and you'd like to close that position, you'll need to place a short cover order. And just like any game, it's important to play wisely and understand the rules. So until next time, keep making informed investment decisions that bring you closer to your financial goals because markets are now open.